Well, first of all, it's a pleasure to be here today with a lot of friends in ACG. I look back and I realize I've been a member now for over 25 years, so that's a nice to see a lot of friends here. And I think we have a great attendance. We have a really fantastic panel today, and what I'd like to start off with, we're going to talk about market trends, what's going on private equity side and on the lending side. I got private equity to my right, got the lenders to the left, and we'll be asking them questions. And then afterward, if we have time, we'll open it up to the audience to answer questions. We're trying to make it a dialogue, and so everyone can kind of really express themselves. So let's just start from the left. Nathan, each one of us will give a brief introduction, about a minute or two, and then we'll get right into the questions. So Nathan.
Thanks to you. So I'm Nathan Brown. I'm with Windpoint Partners. We're based here in Chicago. We're a middle market buyout firm. We're currently investing our 7th fund, which is just over $900 million. And the firm was founded in 1983, really more as a family office for the S.E. Johnson family in Racine. And then transitioned over a couple funds to an institutionally backed fund. So most of our investors now are large pension funds, which is great because they've got a long-term dedication to the asset class. And we focus on mostly manufactured products, both industrial and consumer products. And then we do some business services as well. And the strategy that we employ, that we've been doing now for the last 18 years, which is when I joined the firm, actually, early '97, is we're trying to find companies that really need some new leadership. And then at the same time, we're building a bullpen of CEOs who have run bigger businesses, have got great track records. And then we spend a lot of time in diligence with both and come up with a compelling value creation plan that can really transform that business under our ownership. And it's a strategy that as the markets become more competitive, we've had to continue to refine and hone and focus on over the last 18 years.
Great. Walter, if you could give a little background on yourself.
Yeah, so I'm Walter Florence with Frontenac Company. I wanted to thank Craig and Terry, Steve, and everybody at ACG for having us. Frontenac, we're very similar in a lot of respects to what Nathan described. We're focused on transactions of $150 million and below. So I think generally sort of a tick below the size of Windpoint. We are investing our 10th equity fund. We have been around for going on 40 years. The firm actually was started in the early 70s. Was much more of a venture growth business in the 70s, 80s, and 90s. And we focused 100% on buyout transactions since around 2001. Our target market focus is around 3 core industries. Services industries broadly defined, both vertical market interests as well as some horizontal business applications. Food, broadly defined. And then the industrial markets also broadly defined with a heavy emphasis on the distribution sectors. We have really built our franchise around 2 core philosophies, processes, and strategies. The first is really a commitment to the founder, family-owned, owner-operated business. We think there's both fantastic demographic trends that line themselves up for that being an attractive market. We also feel like we've built the culture, processes, and capabilities that align ourselves really well to be first institutional owners and or partners with that target market. Second is really a commitment to executive sponsorship. We've trademarked it as CEO first investing philosophy, and I'm sure we'll have a chance to talk a little bit more about that. And really excited to be here today. I think it's a great time to be in the private equity markets.
Okay, great. Go next, please, and tell us about Maranon, please.
Great. So Maranon's a middle market lender based here in Chicago. 19 people. We manage about $1.4 billion. We have capital all the way from senior debt all the way down to equity co-invest. We have 4 senior funds, so 4 funds dedicated to senior debt, unitranche, and then we're actively investing out of our 2nd mezzanine fund for mezzanine and equity co-investments. We're generalists, so all across different industries. We'll work with sponsors like Nathan and Walter, but also we'll partner directly with management teams around ESOPs or broken deals or growth financings. Again, squarely in the middle market, EBITDA size 5 to 50. and the firm has been around since 2006. I started the firm with a partner. There's a great path to wealth destruction. It is called starting your own firm and kids. So those two things have put a really big hole in my boat, but it's been a lot of fun since we started the firm in 06.
Thanks, Ian. And last but not least, Jackie, could you tell us a little bit about FirstMerit?
I'm Jacqueline Hopkins. FirstMerit has been around since pre-Civil War days, the 1840s in Ohio. And I joined the firm in late 2012 to start the private equity sponsor finance group. So I provide senior-only financings to middle market private equity sponsors, and we do cash flow only deals out of my group. The bank will do asset-based lending out of our asset-based team. But I'll do cash flow only deals for portfolio companies of private equity sponsors with EBITDA of $3 million and up, so a little bit differentiator, focusing on the lower end of the middle market. And we have commitments to over $300 million that we've put on the books in the last couple of years. So there's been a real commitment to growth at our company to support this asset class.
Great, thanks, Jackie. And I'll just make a brief introduction of Dresner Partners. We've been in business since 1991, about 24 years. We focus on the middle market, serving entrepreneurs, and we do mergers and acquisitions, private placements, and restructurings and valuations. We have offices in Chicago, New York, Palo Alto, and Richmond, Virginia. Some of the transactions we've been involved with over the years, we've literally done hundreds. Some of them are household names. One company that's been in the news recently, Prestini, we sold that twice. Whitman Hart, we did that transaction with Frontenac way back. We've done work with General Electric, McLean Fogg, Ultra of Illinois, Fresenius, DeVita, Children's Hospital, many transactions over the years. We pride ourselves on quality of work that we do. We're also a member, a partner in IMAP, which is an international group of investment banks in 30 countries, 45 offices, and collectively we're ranked number 5 in transactions as a group by Thomson in terms of the number of transactions under $500 million. So that's what we do. So now to get on to the program here, which everybody's here for, and just to set the stage a little bit, we've now been out of this great recession for 5+ years. When 2008 and 9 came around, things really came to a halt, and I've been in this business, I think I count 5 or 6 recessions that I've been involved with, and these all seem to correct the same way. This one was probably the biggest recession that we've seen, but it's also had one of the longest recoveries. It's been a very steady, slow recovery, and now we're kind of getting to a point where things are really heating up. Everyone's very optimistic, which I can see in terms of private equity, strategic investors, and that optimism is translating itself into a heated market. Prices are up, money's very cheap, there's deflation around the world, you see currencies being issued everywhere, and while there's deflation in currencies and increase in money supply, we're seeing inflation in M&A prices, and that would be one of the topics we'll talk about. We're also seeing an unprecedented amount of capital and capital types that are available in the market. With the BDCs, the business development companies, and all the private financing, private equity, and all of the other types of sources of capital, be them fund sponsors, etc., is creating an environment where there's just a lot of capital. We're starting to see a lot of international flows of money, and I think we'll see a lot more of that over the next 5 years, and that's just going to make the market that much more frenzied and competitive as India, China, and other countries start getting into our main flow. So with that sort of brief overview, I'd kind of like to really start asking some questions of our panel. And let's start off with the private equity guys. How do you view the M&A market? Let's start off with Walter. How do you see the M&A market shaping out right now? And what do you see as some of the differences between, let's say, the core middle market, 250 million to 500 million, and the lower middle market, let's say, is under 250 million. So general comments about the market, and then specifically about those segments.
Sure. And a couple of comments. One, I would just start by saying Frontenac's not a broad gauge of the market. We're going to close 2 to 3 platforms a year, 4 or 5 add-on acquisitions a year. I would say the lenders on the panel, their volumes are significantly higher than ours. That said, we probably see 800 transactions a year. We obviously don't spend time on all those, so we track more, numbers of statistics as opposed to, being necessarily a broad gauge. I'd love to answer that question as it relates to why I see it as a good time in the M&A markets, why I see it as a good time to invest, and given the prices, why is private equity still really active? You can make the case that it's probably not a great time to invest. I would, but just to start with that, I think as competitive as it's been, what you've seen is that the private markets are professionalizing and institutionalizing and maturing, but still private equity continues year after year to be an asset class that continues to generate real returns that exceed the public markets over any reasonable period of time. And so I still think, why is that true? I think it's because the number of transactions, the number of companies, particularly in the middle market, is just extremely vast. And if you think about the business that Nathan and I are in, we're trying to do 2 deals a year, fundamentally. If we can't find 2 good deals a year, then our limited partners really shouldn't pay us to be in that business. So I think while it's professionalizing, while it's gotten stronger and gotten more competitive, I think it's just forced us to get sharper at our game. I think there's still great returns to be had out there. Why why do I see the environment as strengthening? I think it's because all the sort of fundamental drivers of the deal markets are strong. The economy is strong. Capital is abundantly available on the debt side, and on the equity side, I think there's continued to be strength in equity markets. And I think the other thing that I've seen, given our executive-centric model, is there's broader education among corporate executives that private equity is a career alternative and a career path. So there's many more deal-minded, deal-oriented executives that may not have thought of private equity as a path to pursue, that today are interested in. I'd love to talk to you, Nathan. I'd love to talk to you, Walter. What is the path and the process of trying to go buy and run and build my own business? So I think that continues to open up and demystify this industry and recognize that it's here to stay and that there's the underpinnings of a fundamentally strong economy and capital markets that are enabling transactions to take place.
There's some great comments there, and I think for Frontenac, who's been in the market, one of the oldest really private equity firms in Chicago now, really at the forefront of the industry. Nathan, could you maybe comment on some of the same issues and how it affects your firm?
Sure. Maybe I'll just comment on some of the things that Walter said instead of repeating him. I would definitely agree that the fundamentals of this market are very strong. The private equity is an asset class is maturing. It's going to be here for a long period of time, and there's going to be a lot of deals. It's a good environment for getting deals done. Where I think we're all still very cautious, though, is whenever you're putting money to work at the top of the market, and you don't know exactly when that is, but looking back, you see in 2014, the average EBITDA multiple of the middle market deal was back to where it was in 2007. You've got to be a little bit nervous, and you've got to be very careful about how you deploy capital. And as Walter said, we did 2 new platforms last year, so you've got to be very focused, very targeted on how you do that. So, in terms of looking forward, frankly, it is one of the seller's market right now. We will probably be selling a few more companies than we buy over the next couple of years until the market changes. And it's something that we're conscious about as we deploy capital in the next few years. We look at companies, which is if there's going to be another recession or some kind of downturn in the next 5 or 6 years, our average hold period is 6 years. How is this company going to survive that? And fortunately, we've got a pretty incredible litmus test on how companies performed in the last recession. And we're going to talk about sort of what you look for later. But I do think if you look at some of these really hot auctions that are occurring now and some multiples that are being paid for low growth businesses that are 10 plus times, there really has been, people have been burned in the recession. And there's this flight to quality, and people are willing to pay up, take lower returns for that lower risk.
Those are good points. Before I move to the lending side, just a couple of follow-up questions. Where do you see deal flow right now, and for 2015? Where do you see it going? Where do you see prices going for 2015?
I saw recently, as I said, we're not a broad gauge of the market. We track our own statistics, but there are others that have much broader gauges. Many people are familiar with Intralinks. Intralinks, I think, has one of the best databases of M&A activity that's out there, and they've had 3 years of sequential quarterly growth in the M&A marketplace. It's interesting. There's a statistical spike in the second quarter because people have got when data rooms open. They're trying to get a deal done before the end of the year, number one. Number two, transactions, people are looking to sort of finalize their numbers for the year that just closed. So second quarter is a good time to come to market. We see deal volume up, each of the last, several quarters. What hasn't changed for us is the number of deals that we're trying to do every year. And so we view it as a good thing. There's more opportunities to choose from, and that's how we tend to position ourselves in the marketplace.
Any other comments, sir?
Yeah, I think it's going to be an active year. I think multiples are going to remain quite high. If you look at we're really, as a team, we're staffed up where we could do 3 or 4 new platforms a year. We've been doing 2. And it's because we're not competitive in the auction environment right now. It's both valuation, but also it's the speed of doing deals. So we see a lot of sponsors out there competing on speed. So they're showing up at a first round bid and they're promising an expedited deal process. And they've probably done some homework up front, or they're already in that industry. They've got reasons to do that. But for us, where we're bringing an executive, we're trying to create a value creation plan that's fairly detailed. We're not able to do deals start to finish in 2.5, 3 months.
So it sounds like you're being a little more cautious, but that also is representing the fact that you've been in the market, both of you guys, for so many years and so successfully. I think some of the studies that have shown, the University of Chicago has done studies on private equity that have shown that the higher return investments have always happened in the years when there's right after a recession, in the early years. So thank you very much for those helpful comments. Turn over to the banking side here. First of all, do you have any comments about the M&A markets? Because you're really just as active in some respects as the private equity. You're supporting them in many ways. And any comments that you'd like to make?
Well, I think I don't want to repeat what people said, but generally speaking, the markets, really there's not been any change in supply-demand balance. Like liquidity is still very high. If anything, there's a lack of new opportunities to buy a property. So, which is forcing cheap money, short supply of opportunities is pushing multiples up. And so I expect that to continue. The only issue is, depending on how you finance it, and that's getting to where we focus, is the regulatory impact is starting to affect what at least regulated entities can do. So I'm expecting to see either a increase in equity, not likely, or sort of a shift towards alternative financing vehicles to make up that difference of what regulated entities are doing. So we're probably going to see sort of a shift away towards regulated towards unregulated entities, or you're going to see, or if investors prefer to stay away from that a little bit more expensive debt, you're going to have to see a little more equity in the short term.
Interesting. Okay. Ian, any comments there before we ask some other questions?
Oh, I have comments. Don't worry about that. I'm just surprised you started with the private equity guys, because I think everybody here came to hear what the lenders have to say. Gee, I wonder what the lenders think today. But no, all kidding aside, I think that what we're seeing is what Walter and Nathan said, a fair bit of activity. I completely disagree, though, with your opening comments. I've always wanted to say that on a panel. That's fine. I'm just kidding. I don't know how many people here feel like the economy's better, or that we've been in 4 years of recovery. We're scared out of our minds, and maybe that's just the way that we've been operating since 07, 08. It doesn't. I know it's better statistically, it still is rocky out there. And, the world has gotten a lot harder over the last 8 years. So we can all cry about it or go find something else to do or just kind of power on. So we've all just been powering on. I appreciate Jackie's comments about the regulated versus non-regulated. I think we're starting to see that a little bit. In a weird sort of way, though, even though we don't have the OCC and Dodd-Frank and everything else, well, we do have Dodd-Frank, they're trying to regulate us in other ways. They're trying to squeeze our leverage lines. They've made us register and are trying to squeeze us that way. So it's not like the powers that be have completely ignored the non-regulated side. So I think you will see a shift where financing will probably tighten up a little bit. I don't see purchase prices coming down. There's just too much private equity, frankly, on the sidelines. I think that there's a myth out there that financing, readily available financing, cheap financing drives private equity multiples. Maybe it's number 5, but number 1, 2, 3, and 4 is just the amount of equity that's out there, and there's not enough deal flow, so we need to get the market going a little bit. I think for most people in the room, or a lot of people in the room, they serve private equity. I mean, we are service providers to private equity. We sell and rent money. And for us, that's a good thing. There's going to be more activity. I think, and Nathan and Walter, I think, do this in spades. You got to create value from the day you buy it to the day you sell it. And it wasn't like that when we all started in the business. You can buy it cheaper, you can finance it differently, and then you can sell it for a higher multiple. That's all kind of basically gone away. I know there's proprietary deals, etc., but we just see, I am optimistic that what we all do, it's a growing industry, and it's institutionalized and professionalized. So we're excited about that, and I think most of the audience members should be as well.
I actually have a follow-on question for Walter Nathan, because based on what you said, Nathan, or something what Ian just responded is, we talked about buying at a lower multiple and selling at a high multiple. I think it's completely inverted today. And I was curious to see, to me, it seems like you can only build a return if you bring the kind of value you're talking about. And so my question is sort of, when you do your exit analysis, sort of use factoring in sort of a lower exit multiple or consistent, or how are you thinking about exiting?
That's a good question.
Yeah, that's a great question. So first of all, to Ian's point, times have changed. Everyone needs to add operational value during the whole period, and Frontenac and Windpoint do that by basically bringing in new management and supporting them. So what we hope to do in order to drive our exit multiples is to fundamentally sell a different business than what we bought. So we're mostly buying businesses in need of new leadership, and they've been usually held by a founder for a long period of time, or they're a corporate orphan, so they haven't been investing in growth. There's some quicker payback things you can do on the operations in terms of investments. But then we also aggressively go after add-on acquisitions. So if you look at our current most recent fund, it's 11 companies. So we've done 11 platforms over 5.5 years. And we've done 24 add-on acquisitions. And we've taken revenue we've acquired about 1.2 billion in revenue in total. And that's now 2.5 billion in revenue. And a lot of that came through acquisition. We didn't get that kind of organic growth in these mature industries. So what we're trying to do is, start with the better management team who can run bigger business. We're going out, we're growing the companies fairly aggressively. And then when we sell a business, we have a company that has a higher growth rate, hopefully higher margins, and is more diversified across customers, products, and markets geography. So I think, the concept of trying to create arbitrage through timing, that's a fool's game. You can't win that one. So what you have to do is really make sure you're selling something fundamentally more valuable. Now, having said that, our average entry multiple for our new platforms in the last 5 years is 6.7 times, compared to about 8.4 times the market average. So we are trying to compete in less competitive environments and get more negotiated deals. But I think the arbitrage fundamentally for us is coming from the fact that we're buying something that's 1 to 500 million in revenue, selling something to 500 million and 2 billion in revenue.
So we're looking at overall returns. Multiples sometimes can be distorted. To your point, people tend to buy platforms at a higher multiple, their add-ons at a lower multiple, and then their average multiple is probably lower than their platform multiple. But your point about timing, and that's not the be-all and end-all, and what you're doing to fix these companies and make them better operationally is something we'll talk further about. Getting back to the lender side again, could you talk a little bit about, we're in an environment now where interest rates are low. Where do you see those trends? And where do you see leverage multiples in terms of what you're willing to do for transactions? And what you see in the market overall? Are we capped out? Is it still going to go higher? And your point that maybe it's coming from the equity. It has to come from the equity because there's so much demand. But you could talk a little bit about those two things. Where do you see interest rate trends? And where do you see multiples? Ian, maybe you start first with that, please.
I think Jackie's got a better perspective, but I did notice too that they set the microphones to Nathan's level, so that all of us are Jackie's. There you go.
Actually, I did that, Ian.
You seem so nice, but you are a private equity guy.
That's why they're sitting opposite sides.
Right.
They are friends.
We got a fence here.
We're neighbors.
We got the investment banker.
We co-host a block party, but we'll leave that for another day. But no, so I don't know where trend or interest rates are going. I'll let Jackie answer that. I think leverage is kind of capped out. I think because of the regulations, I think just how high it is already, whether it's grease or whether it's oil and gas and energy issues, I feel like we're kind of at the peak. I mean, we've seen things moderate. That said, I don't see it coming down to the old, total debt of 4 times, a 2x4. I mean, we're in the middle market. We're somewhere around 5.5, 6 times for a good business. I mean, there's exceptions, but it's kind of 5.5 total. Banks have certain restrictions, but a lot of deals don't get done by banks. So it's not like they're driving, total or even senior leverage down.
When you say 5.5 or 6 times, can you maybe explain to people how much of that is senior, how much is mezzanine, is it blended, is it a unitranche, or how do you look at it?
Yeah, there's all these different structures, which I won't bore the crowd with, but just a traditional deal, we're typically seeing if it's 5 times, it's maybe 3 turns of senior leverage and 2 turns of mezzanine, or some blend, a unitranche to 4.5 or 5 times.
Okay, perfect. Jack?
I think as recent as fourth quarter of last year, we're seeing leverage levels higher than what Ian talked about, and those deals have tend to gotten stuck. So it's I think ebbed a little bit in terms of the total leverage in the marketplace to the levels Ian mentioned. And again, it really depends on the type of deal. If you're talking upper middle market versus lower middle market, upper middle market are the levels that Ian spoke about. Senior between 3 and 4, and total between 4.5 and 6, right? Depending on the industry. At the lower end of the middle market, probably comes in a little bit because those companies can really sustain less financial volatility given the business risk. So those transactions tend to be lower levered, like 3.5 to 5 sort of levels, depending, of course, on the transaction. And those often will have an execution that is away from the institutional side because they're smaller and there's less liquidity for those transactions. So those deals will tend to get done in the bank market. And what that means for borrowers at that end is you're going to see a different kind of structure. As opposed to the elongated maturities where you have very little amortization, the bank transaction execution will require amortization, probably a little more attention to covenants and things like that, and lower leverage. So they also will have a lower price tag. So the bank execution can be a very economic solution, and it might be the best opportunity given a size profile might not be as attractive to an institutional deal.
Yeah, I think just to toe in there, I think Jackie's hit a good point, and that is for everybody that's looking at transactions or working with private equity firms on transactions or even the lenders out there, I think we tend to talk in terms of pricing and leverage. And the market, there's so much else that goes into a deal. There's the amortization side, there's the covenant side. So not, everything's reported as pricing and leverage, but I think the market has changed in terms of structures, and so not every deal is created equally around those. And I think our clients are very careful not only to think about pricing and leverage, because those are certainly keys, but also some of the other things that Jackie mentioned, like amortization.
Yeah, go ahead.
One of the points
Those are great points.
They made, which I just want to sort of draw out, because I think I heard it correctly, there's more leverage available, you guys say, for a $15 to $20 million EBITDA business than for a 5 to 7.
Yeah.
Right? So if you just think about that and you say, how do I make money off of that structural observation in the marketplace? If we can buy, and I think we're set up to do this, you guys are a little bit larger, a $7 million EBITDA business for a prevailing market price, high, low, medium, whatever the prevailing market price is, and we're successful through execution, real growth in revenue and earnings, maybe with add-on acquisitions to expand geographies, expand products or services, expand customer base, and get that business both professionalized and broadened in scope, we believe there's a structural premium in the marketplace that will allow us to get paid, not just for the real growth, but there will be more financing options available to that. Those financing options are ones that we can either take advantage of from a debt or dividend recap standpoint, or to provide stapled or more attractive financing to sell to larger equity funds or to corporate buyers. And so you can still pay full market price for a $7 million business, sell for a full market price, for a $15 million business. You're not buying low, selling high. You're getting paid for the risk that you're taking, trying to scale something from point A to point B. And that's really where we've tried to define and live in our marketplace.
Those are good points, and just your point about liquidity, that there's more liquidity options in general, is something that I think also is fueling the market with more transactions and higher multiples. Hey, back on this side again, the lender side, the Office of the Control of the Currency, is focused. Boo! Oh, sorry. They're not here. Right. Off the record. Probably don't have to finish it. Probably don't have to finish the lesson. Okay. So, no problem. They're increasingly focused on bank capital, risk in the bank portfolio, and given what we just went through in the last recession, where things were, out of hand as far as leverage, we hear rumblings that they're back, they're talking to the banks, and I don't know how much the unregulated side as well. You mentioned that briefly. Talk a little bit about where do you think that's going? Will that put more discipline in the market? And do you see anything happening right now that would be of interest to people here?
I'll take that because here's the thing with regulation is, as a regulated entity, they really don't tell us what they're looking for. So so you have bank management teams across the country trying to anticipate what are the hot buttons for the regulators because they won't tell you. So it's kind of like you sort of have to prove your innocence is I think the mindset of many management teams today. It's like, what have we done that we think will be a focus for them, and how do we manage around it? And the answer to that question will vary by institution. I think generally speaking, people sort of go, yeah, leverage over 3x4, which is the regulations guidelines, is one point of reference in terms of what regulators are looking at. It doesn't mean you can't do them, but I think people are scrutinizing them more carefully and perhaps pricing them more highly. But other than that, it's really hard to tell what they want. And until this year's exam is through, which is beginning right now, we really don't know what they want. What kind of projections do they want? What kind of analysis do they want? What kind of features do they not like? There are certain things that they have said that they don't like, which these guys aren't going to want to hear, but there's some things like they don't like equity cures, they don't like covenant light. There's certain things that they have expressed publicly that they don't like, but there's a whole layer of uncertainty regarding about what they don't say in the public disclosures. So I think you're seeing a period in regulated entities right now this year, Steve, that is, people are I think, retrenching a little bit because they want to make sure that they come out of it at the other end without the clarity we hope to have.
Without being penalized, and do they penalize you if you have too much in your portfolio that doesn't?
Yeah. So they talk about we're going to have a HRA cost premium. I don't know what that means. I don't know how much it is, and we're just going to have to see. I think for FirstMerit, we're not changing our business model. We've not changed our leverage in response to the regulators because we didn't go to the very high levels to begin with, given our focus on the lower end. So it's less of a concern, at least intellectually for me. We're sort of staying out of the danger zone that some of the large banks, sort of the big underwriters like, Credit Suisse, who's gotten some press, et cetera. So we're not in that mix of the things that are most inflammatory to the regulators, but that doesn't mean there's not going to be something that they don't like. So I think we're okay. We have not changed our business model in any way, but we'll see what happens, in the fall when the reports come in.
Great. Well, those are great answers.
Yeah, no, just to add, it's the Spank a Bank rules, right, that have made banks pull back. And we've been talking about this for 2 years. It's been out there for a couple of years, and now we're just now starting to see banks pull back a little bit. But for us, it's also, that's half the equation. The other half is risk retention that's coming up next year. So that will also drive, certain sources of financing to really tighten up as well. And that will impact directly the CLO marketplace, which is indirectly or directly funds a lot of the M&A, private equity M&A spot, especially in the bigger deals.
But it's significantly more than banks, right?
Right.
Today, that's been the case for years. So I don't want to overemphasize the impact banks have, but it does have an impact.
Yeah.
Great. Okay, those are great answers. I want to shift the focus a little bit to private equity and talk a little bit about how you use executive management to really drive value in your businesses. And you spoke about it briefly, but what are some of the techniques you use? How important is it to your business? Give folks here a kind of sense of that. And also, how important is that relative to other operational or financial techniques that you might use when you compare the executive side?
Yeah, I'll take a shot at that. And I think we have relatively similar philosophies and models. But if you buy into the theory that I espoused earlier, in our business is trying to buy a $7 million EBITDA business and grow it to 15 to 20. How do you do that? Our view, and how do you get paid for that? Our view is you get paid for real growth in revenue and earnings. That is large part driven by great execution. You have to be in a good business. You have to have good timing. You have to have a lot of other things. But at the end of the day, we're not at these businesses on a day-to-day basis. And execution, in our view, is what makes the difference. And execution is about great leadership. It could be incumbent leadership in the companies that we back. We back, a lot of great incumbent managers. What we want is an open mind, set of partners that are willing for outside advice or willing to recognize that there are other people that have seen, playbooks in other industries, and they're receptive to that input and that advice. And so we think execution is critical. We also think it's tied to a philosophy around trying to make money on real growth in revenue and earnings. The other side for us is, the other big differentiator for us, and I believe in the markets today, is sourcing. How do you source transactions? And we get, several hundreds transactions a year, and there's a lot of great ideas out there. What is our challenge? How do we set priorities? And one way we set priorities is to try to align ourselves with executives where we have a thesis in advance of deals coming to us. It may be a narrow thesis, it may be a broad thesis, but it reflects a point of view about why this is a good category to be in. And then within that category, our job is to deliver to that business owner who's looking for liquidity, succession planning, and unlocking a growth opportunity, a set of financial capital and human capital solutions that helps them accomplish their goals and objectives. So if that's the customer that we're talking to and our future partner, regardless of the transaction that we're looking for, we believe the philosophical side of a leadership-driven model is a great way to build value. And the process side helps us on our sourcing strategy. It also helps us on our post-closing value creation thesis.
Great. Those are great answers.
I would agree. It is 90% about execution and making sure you've got the right team to do that. So I think it's Jim Collins, good to great, and the right people on the bus theory. That's something that we focus on up front. So we start with the CEO, so we do a lot of vetting of the executive. when we go into the deal, we already have that partner, but then we look at the rest of the team as well, and we compare not just how they've done the last few years, but look at what we're trying to build and how much bigger and more complex is that, what is the challenge ahead of this company. And so we're going to be adding team members, we're going to be top rating team members. We generally turn over about 70% of the CEO's direct reports in our first year. So it very much is a conscious effort on making sure we've got a world-class team right up front, because I've been with Windpoint 18 years, so I've never had a real job myself, so I don't want to rely on me to have to do things. So we've got to make sure we've got the right team there and they're properly incented.
So are there any Windpoint portfolio companies here this morning? I would start looking for a job. 70% is a big number.
New companies.
Any new portfolio?
Yeah, and I think that's a great point. I mean, we're an executive-driven strategy, so I think a lot of people say you're looking to change management. We're not looking to change management. We're looking to look at what are the skills necessary to take the business to the next phase. How do we build around the strength that's there? And do we find partners that are open-minded to new ideas, new involvement? So I can't speak to what Nathan said, but in a lot of cases, it's adding expertise as opposed to subtracting expertise. The game gets faster, the jobs, the requirements are greater to grow these businesses in scale. And what we're willing to do is we're willing to invest off the P&L to bring additional talent into the businesses, to put the incentives plans in place that align us with what those management teams are. It's not a replace management strategy, and I totally respect why, in some cases it gets to that, right? I think we've all had those situations, but it's really more around how do you build around the core of strength. And we deal with private business owners all the time. One of the first conversations they have with us is, there's several things I've wanted to do with my team for many years. I just never had the motivation or catalyst to try to do it. With this transaction, it's time for me to address these settings. We're not driving those discussions. The business owner or the leader of the day-to-day company is driving those. We're creating the environment that allows them to change the way they think about upgrading their team.
Yeah, just to protect our reputation here.
Nathan and I talked about actually getting in a fight, and so I'm getting a little nervous.
Getting there.
Yeah, sorry.
So I agree with Walter. We call it management overkill. We're actually adding more overhead to the business early on. And like you said, off balance sheet, we will fund some of that through a holdco, so it doesn't affect the financing really. But I think what you do need to appreciate is, as Walter said, we're buying these family-owned businesses. A lot of times there's family members that want to walk away, and that's why you do need to. But a funny story, we had a company a few years ago, and the owner was the CEO, and his son was head of sales. And he pulls us aside, he's like, I never told you this, but you have to fire my son. Sometimes it's more.
So, in this process of maximizing value, have you ever made a mistake, or how do you avoid a mistake without necessarily revealing a mistake? But what do you do to avoid a mistake? And if you've made them, or what do you do to make sure you don't? Because obviously you're making a lot more correct decisions than not, given the success of your companies.
I have a clear view on this. I think it's more in our business. We get evaluated by our investors all the time, right? And it's not have you made a mistake or haven't you made a mistake. It's what have you learned from those mistakes, and how has that changed your process? And so I think the emphasis on due diligence, the emphasis on assessing managers, the emphasis not just on what I call the hard due diligence, of the legal and accounting, but the soft due diligence of the culture of those businesses. Do people really want and embrace partners? Testing that by having some, disagreements, but sort of sound disagreements around business principles before you close a transaction. It may even put the transaction at risk. We'll really test, is this relationship going to work? If you can get that relationship to work, I think you're 90% of the way there to the success line.
Yeah, I would just add to that, I think we all need to become more focused as well. So we've got to
Strength for strategy.
Okay. Any comments you guys have on executives, because you're obviously funding them too, making decisions there?
Yeah, I mean, we're really relying on the sponsors, but in the middle market, it's never been about industry trends or even, frankly, add-ons. It's always been about the management team. We've seen lots of businesses that should have failed miserably, but a good management team got us our money back, and vice versa. So for us, we spend a lot of time, trying to get close to the management team, really understanding it. But I'll be honest, I mean, we're lenders, so we're looking for mediocre businesses. So we're not going from good to great, we're going from okay to good, right? That's the book that we play off of. So we want, managers that will, not necessarily mess it up. The growth is great, and we want the private equity folks to make a lot of money by growing it. We're not going to oppose that at all. We're going to structure so that you can put in a little bit more overhead and see a little bit of dip and then move it back up with the growth. So we're not opposed to that. But at the end of the day, we need a nice, steady business to pay us back. So yes, it's very important, but we're really looking for the outlier. Is the culture bad? Somebody mentioned culture, and that's so key. I mean, every bad business we've been a part of, there's been, a bad manager with a bad culture. It hasn't been about, there's been some industry headwinds, or maybe it's an over-levered add-on, but it always came down to management.
Yeah, I would say, as a lender, you have neither the access nor the influence to make the decisions that the equity guys are making on who's going to lead the company. We trust they'll make those right decisions. I think the one thing that a lender always cares about is what's the financial reporting. That's something that we sort of get on a monthly basis. It's important. And whenever that's messed up, it's usually a sign of trouble. So we expect the financial reporting to be, sort of one of the top focuses of a new acquisition, because generally they're taking a company that does not have those kinds of disciplines and having to report a significantly different, package on a regular basis. And whenever those things are slow or wrong, then it's usually a problem.
There's an amazing lack of depth at the CFO level. I mean, just about every business we've ever invested in, they have a controller called the CFO, and they can never make that transition to go from internal reporting, maybe barely, to dealing with a lender. And I've been doing this 25 years. I'm not sure why there's not a deeper and better pool of CFOs, but at least in our experience, and these guys have a lot more experience at it than I do, it's really hard. That's the position that always either gets added to or transitioned. And it's amazing how difficult it is to find a good CFO.
Interesting. I mean, interesting the different insights in executives, what the priorities are. One is really grow value and make change, and the other is to conserve value and at least make sure that people are paying the debt and getting the right reporting. Let's take another topic that I think really applies to both sides, and that's sort of your attitude about what I'll call off the grid, infrastructure for getting transactions done, be it fundless sponsors, be it working with a private equity group versus an independent company or a fundless sponsor. Do you have any sense of which you prefer or don't prefer? Do you stick with sponsor groups or non-sponsor groups? What's your feeling about that?
It's a really easy question because it's part of our group strategies, different probably for Ian. But we only are lending to sponsors with committed funds. So we don't do the family office. Because really when you're doing, it's a dodgy neighborhood when you're doing a cash flow loan with a $4 million company, right? You can lose your shirt. So the thought process, at least at FirstMerit, is you want to have some capital behind it that has the experience, the integrity, and the capital to support a credit that wobbles, because one of them is going to, right? So our strategy is, needs to be a sponsor that has a committed capital fund, and that's all.
Yeah, I completely disagree. But this time I really do, actually. Well, I know sometimes. But no, all kidding aside, that's a great strategy, and I totally buy into that. We'll do sponsored, but also non-sponsored. But the world has fragmented. I mean, for anybody that's calling on private equity firms just to pick up cranes and start calling those folks, you're missing like 80% of the market. 20 years ago, you would have hit 80% of the market. Now you're missing 80% because there's so much out there that's getting done by what I I would say are, really good independent sponsors with lots of money who are going to support their businesses. So back in the day, you used to see independent sponsor, more like a deal broker who wanted to be a private equity person and then committed fund. And the world, at least in our mind, there's been a lot of blurring of the lines. I mean, there's folks out here, Dave Hopkins and Chip Grace and others who, yes, they're working with some committed funds, but they are seasoned private equity professionals who have a lot of deal experience who don't show up on a lot of those lists yet. Now, at some point, they will pop into those and enter the, people will see them alongside GTCR and Frontenac and Windpoint, etc. But I think you're missing, we would be missing a lot of our world if we weren't really thinking about the family offices going direct, the independent sponsors. One of the biggest private equity firms in Chicago that's been created over the last few years is, the Pritzkers. They're trying to put out, one arm of the Pritzkers trying to put out $250 million a year. That's not in a lot of lists yet. Another one's BDT Capital. No one's ever heard of that, but they just raised $5 or $6 billion. I don't even think they have a website. So you really have to, in today's world, because of the fragmentation of deal sources, I think, and we're trying to do this, really try to mine, those other sources of transactions. We tracked 2,200 private equity firms, and only about 30% of those did a platform last year. So Nathan and Walter, they do 2 or 3 platforms. They're one of the top, most active private equity firms in the country. So I know they're talking about a niche strategy, and we're not that, we're very focused. But if they really peel down through the numbers, they should feel very, very good about where they stand, because 70% of private equity firms last year didn't do a platform. They did a lot of acquisitions.
It felt like we worked really hard last year.
Yeah.
My view on, just real briefly, is, we, and this is a quick commercial, we love the independent sponsors. Anybody that's out here that's an independent sponsor, we'd love to talk to you. We can partner with you effectively, and try to get deals done. So for us, it's an additional source of deal flow. It's not competition. We're not the right capital partner for a lot of those groups, but we welcome talking to them. Usually they have an angle and an insight and access to a transaction, and they're looking to try to get them done. And we're open for business, in that regard. I'd say on the family offices, I think it's great for our industry. I think they're great long-term patient capital. They're great buyers of our business. They actually do what they say they're going to do if they show up in processes. They're looking for slightly different types of assets. If what we do successfully is grow a business to get to scale and professionalism and maturity, they arguably are better long-term owners if they're going to be in that business long-term. And so that's a great new source of exits for us. So I think it's great in that context. And then third is they're great sources of capital for us and our funds. That's a great way to form a partnership. They don't have to be huge investors. They can be investors, and it adds to our kind of mutual network. So I think it's a big market. There's room for everybody, and we welcome doing business with anybody on both sides of that.
Nathan, any comments on that?
Well, I think the increased competition is inevitable. There's just a lot of capital up there chasing returns, and we've had great returns in private equity over a long period of time. And it is interesting to see the different forms that it takes, and I think it just reemphasizes the fact that you do need to be very focused and have a very particular strategy. And a lot of the family offices and some of the pension funds have added direct investing capabilities, and they really want a strong management team in place. So at this point, we're really not running up against them as direct competition, a lot of deals, but clearly they're a huge factor.
Are you looking though? Are you in your add-ons? Are you running up against independent sponsors and family offices for the add-ons, maybe not for the platforms?
We are. In fact, our biggest deal we did was just last year. It was an add-on. It was a $570 million transaction. It was an add-on to a packaging platform we had, and we only won it because we ran really hard at it and did a lot of our diligence up front. There was a family office here in Chicago who had a higher bid at the second round bid, and just speed and certainty won us the deal. They are effective.
Those are good answers. As an investment bank, we're seeing a lot more fundless sponsors out there, and sort of integrate what people are saying here. Sometimes I think they add a lot of value. I think you just have to be selective of who you're working with. Some of them are outstanding. Some of them have private equity guys that know what they're doing, and they work with funds like yourselves, and they can add value to you. But it's just, I think it's indicative of the fact that it's a more competitive market. People are looking for deal flow. One more set of questions, and I think we'll get close to wrapping up here, given the time. On the equity side, most of the time, the private equity firms we work with are looking to do control transactions. And every once in a while, when the market gets tough, there's not a lot of deals out there, they say, well, we'll do a non-control transaction. You always get the Warren Buffett type situation where, for example, what he did with the Marvin Group, where he bought half of it and bought the other half later. And you see that structure. So if you could talk a little bit about what is your view on control versus non-control in terms of your funds and just in general. And I think Ian, this would be probably something that you could talk to as well as Jackie.
Oh, I can talk to anything. And I'm trying to think of something to piss Walter off because I've done a good job with Nathan, you, and Jackie. So.
While you're thinking about that, let me answer the question.
We planted him here.
No, seriously. We're not averse to control or non-control transactions. 90-95% of what we do is control transactions. What we're not doing is we're not financing A, B, C, round transactions. If it's a good investment opportunity, much like you described with, Marmon's and the Berkshire deal, where, there's a path to control, and it's more about, economics of 50, 60-40 or 55-45, where we're not in control, but we have effective, kind of material rights, and somebody wants a partner, then we're very open to that. What we don't want is, we're not just money in a deal, we're a partner to somebody. And if they want our opinion, they want our voice, it comes with strings attached, then the economics to me is a different question about governance. And those tend to be more 60-40 deals where there's a set of objectives that, over time you could, see yourself getting to control. But all day, every day, we would view ourselves as controlled by all investors.
Okay.
The non-controlled deals is tough to fit with our strategy because of the amount of change that's going on in the first year of our ownership. So it doesn't really fit for us. We have done deals with our limited partners as sponsors. We've done deals that are 50-50 with them coming in, but we're clearly aligned and we clearly led the transaction. For us, it's really not something to consider. I think it could be a successful strategy, clearly, but we want that opportunity to really transform the business, go after it aggressively. We don't want anyone else to have the right to say, no, you can't do that add-on, or no, you can't hire a CFO.
Okay. Good answer. And Ian, any?
Yeah, we'll look at non-controlled transaction and partner with Walter, or in maybe a rare case with WinPoint on those, because they'll always have control through the documents. So for the important things, they'll have control. But as Walter described, it may be more of a 60-40 deal. So that doesn't bother us, and we'll partner directly with the management team. So it doesn't necessarily have to have a sponsor who has control.
We have done a transaction where, from the percentage standpoint, the sponsor didn't have economic control, they had executive control. So that's what we view as actually more important. And we kind of like the idea that there's, usually when it happens, there's existing management is rolling. And so that is a real signal to us about how the team feels about their own business. So we think it's a positive because it says that this team really wants to take this company to the next level and has put their money where their mouth is from a contribution and equity standpoint. But we still expect the sponsor to exert control regarding key decisions like around acquisitions, personnel, etc.
Can we ask Steve a question?
Sure.
What's in your pipeline? We're all here for deal flow.
Well, I would tell you that our pipeline is filling, and there's some good deals that, in fact, we signed one yesterday. So maybe we'll talk to you about it, but we don't actually disclose exactly what they are. But I think in general that what you're seeing now is that prices are getting awfully high, and sellers are very attuned to that, and so they're coming out of the woodworks. We've had companies in the last month or two. We had one company that we talked to several years ago. Their EBITDA was, let's say, $5 million, and now that same company is more like a $10 or $12 million EBITDA company, and they're seeing multiples that are much higher because the growth rates are higher. So people are coming out of the woodworks. I think you will see more deal flow in the next. I think we're at a point of a cycle right now that I see where we're not the ultimate frothiness where things are going to start falling apart, but we're getting pretty high, getting pretty steady, and so you're going to see a lot of people coming out of the woodworks, and eventually the window closes. I mean, timing is, ideally I always tell people when you're selling your company, worry much more about your performance than the timing of the market, because you're going to get a higher value regardless of the multiple if your performance is high. But when your performance is high and multiples are high, then if you can be in that situation, if you're fortunate enough to be able to time when you want to sell your business, whether you're an owner, an entrepreneur, your personal situation is such that you're able to sell your business, then try to maximize it. So I think pipelines all over are filling up, and we're seeing just a higher level of intensity everywhere. So, and I would argue that that's really what's happening with everybody. So before we conclude here, because I think we need to end, does anybody have any final comments they'd like to talk about, and really any apprehensions at all for 2015? You said you were scared, Ian, but any final comments for any of our panel members here, and then we'll stop.
I guess the message I'd leave is we're open for business. We'd love to talk to you if you have opportunities.
I just say that I think this market, you've heard the theme over and over again, it's just increasing competition, number of players, etc. So everyone's just got to focus on getting better at what they do well already. And so really, as we look forward the next few years, that's our primary focus.
Great.
I think in general, 2015 will probably feel a lot like 2014, leverage rates, etc.
Still scared.
Okay. Well, with that, I'd like to thank our panel members here. I think they all did a great job.